Okay, in this video, this is the first of two videos where we're going to look at the stance of the RBA or monetary policy over the last 2 years, and also talk about reasons why they've implemented this stance. So I'm going to take you through sort of the last 10 years, but I'm going to do it really, really quickly because you only need to know the last two years. The reason I'm doing this is just to give you an idea of the kind of things the RBA will look at that were going on at different times that affected their monetary policy stance. So don't worry about what the cash rate was in all these years. It's more about just the knowledge of, okay, why did the RBA act, and getting your head around factors that can cause them to act in a certain way. So in terms of going right back to 2007, the RBA increased interest rates during this time, so they're a more contractionary stance. Some of the reasons for that, so again, just this is the theory as opposed to this doesn't really matter what they did. Underlying inflation was really high, we had high terms of trade, unemployment was really low, so wage pressures were starting to emerge, we had tight labour markets, and the other issue during this time was that this bloke, Kevin Rudd, he was being really expansionary with budgetary policy. So when budgetary policy is more expansionary, that can cause inflationary problems, so monetary policy has to be more contractionary and essentially be the responsible one. So when you want to win an election, the budget's generally more expansionary, and that sometimes put pressure on monetary policy to be more contractionary and slow down growth and slow down inflation. In terms of 08, 09, the GFC hit. When the GFC hit, just before the GFC hit, they had actually increased interest rates even further to 7.25% because there was continually strong inflationary pressures. And then suddenly we experienced a drop in growth, and the RBA dropped the cash rate all the way from 7.25% to 3%. So there was a massive cut in the cash rate. The idea was this was to avoid recessions, and the fact that underlying and headline inflation were actually still above 3%, but there was forecasting, and they were predicting that over the next 2 years we were likely to experience very minimal inflationary pressures. So a good example of the RBA looking at leading indicators and reacting to those as opposed to the current rate of inflation. So the idea was for monetary policy to have a more expansionary effect on the economy. Over 2010, the economy started to improve again a bit. We sort of recovered from the GFC, and they went to a more neutral and then a contractionary monetary policy stance. So we had weathered the GFC. This is when China took off. So China started to demand a lot of our commodities. That helped boost growth. The mining boom started, and the Australian economy was starting to look good again. Unemployment was down to 4%. So we'd recovered very quickly from the GFC, and suddenly, mainly because of the mining boom, the economy was growing really fast again. Wage pressures were high. We had a strong property market. The government was being expansionary, which forced the RBA to be a bit more contractionary, and there was a record terms of trade. So all these things led to an expansionary economy, or a strong economy, and the RBA ended up being more contractionary. 11 and 12, inflation started to subside. Inflation dropped to 1.9%, so the RBA loosened monetary policy. They reacted to the lower inflation. From 13 to 15, the cash rate went from 2.75 to 2.5%, so they lowered the cash rate slightly, just once from that period from 2013 to 2015. The reasons for that was that the economy was looking like going a bit slower. The mining boom had finished, the terms of trade were starting to fall, retail spending was falling, weak consumer confidence, commodity prices were declining, growth was below our target range, unemployment was at 6%, so a lot higher than what it was during the mining boom, and all of these were having a negative impact. This was also the time where the government started to be more contractionary with budgetary policy. So it was during the Hockey years and Abbott years when they had some really contractionary and unpopular budgets. And that led to the RBA loosening monetary policy. Just be mindful, during this time, there was also record house prices, and household debt was starting to increase, or was increasing significantly. So that's why the RBA didn't act sort of too swiftly to lower the cash rate by too much. They lowered it by 25 basis points, but because of high levels of household debt and record housing prices, they didn't want to stimulate spending on houses too much. In 2015, they lowered the cash rate from 2.25% to 2%. And then in 2016, this is probably the first time where the actual rates start to matter. 2016, in May and August were the last two times they've changed the cash rate. So in May and August, they lowered the cash rate to 1.75% in May, 1.5% in August, and they were starting to recognise that they had to be more expansionary with monetary policy, with the reasoning that people weren't spending the extra money. So this deleveraging effect, these high levels of household debt, meant that they had to be more expansionary with their monetary policy setting. Okay, so if you look at the statement, for some time the RBA has noted that the inflation outlook provided scope for a further easing, e.g. inflation is not a problem, so let's decrease interest rates. After taking into account the developments over recent months, the board recognised that we can become more expansionary. They were a little bit worried about the housing market and the fact that housing prices were going up, but having said that, this is during the time where the banks started to implement more supervisory measures to try and make it hard for people to borrow. So that helped to contain spending and allowed the RBA to be more expansionary. Taking all these measures into consideration, the RBA decided to ease or loosen monetary policy. So in 2016, some things that were going on. Okay, again, I won't go into this in detail because it's really about the last 2 years. But unemployment was above our target range. There was slow global growth, and high levels of spare capacity, which all provided incentive for the RBA to loosen monetary policy. The government was pursuing fiscal consolidation as well, which meant that they were keeping their bargain to keep inflation under control. There's also high underutilisation rates. But we didn't want to loosen monetary policy too much because property prices were still higher. The exchange rate was a little bit lower, which was causing inflation, and export volumes were starting to improve as well. In 2017, 2018, this is pretty much the key things that you need to know. So the reason I've done the rest of it is to show you what they react to and what are some of the key factors that impact their stance. But really, the last 2 years, the RBA has kept the cash rate at 1.5% consistently over that period. They've employed a highly expansionary monetary policy stance and maintained that stance, but they have resisted any further tightening or loosening. So there's been a range of factors which have prevented them from either increasing or decreasing the cash rate. In terms of 2017, and some of these are a little bit different to this year, but again, the government pursuing fiscal consolidation meant that the RBA could be more expansionary. The banks tightening their lending standards made it harder for people to borrow and controlled inflation. There was high labour force underutilisation. This is less of an issue now, but that put less pressure on wages. Mining investment was weak. Inflation was within the target range. Some of the key things that were going on. Confidence was also low. In terms of things supporting higher interest rates, so reasons why they didn't make the monetary policy even lower, is the fact that commodity prices started to pick up. Headline and underlying increased slightly last year. There were strong property prices. This has subsided a bit this year, but there were strong property prices last year, strong export volumes, and unemployment was going down a little bit last year, as it has this year. All right, this year, key things. So again, don't memorise all of these. You don't have to memorise all these factors. Just think, all right, what are some key factors that are causing the RBA to keep interest rates low, and what are some factors that may cause them to raise interest rates later this year? So what kind of things could happen that are starting to emerge that may lead to a tightening? So from a loosening point of view, again, the government continues to pursue fiscal consolidation, so it's up to monetary policy to be more expansionary. The big ones are slow growth in wages. So the RBA, let's put less pressure on inflation. Inflation is still at the bottom end of our target range, so we're able to be expansionary still, knowing that inflation is not a concern. The tighter lending standards by the banks as a result of the Royal Commission has meant that the RBA can afford to be more expansionary because the banks are stopping people from lending. This is probably less relevant now because it's more about last year. And the negative growth in property prices has meant that the RBA is not as worried about rising property prices anymore. In terms of factors supporting higher interest rates, so things that could cause inflationary pressures, the terms of trade has rebounded a bit in the last 2 years. There's been lower savings ratios. Consumer confidence has improved this year, so that could create more spending and growth. Strong overseas growth, which is compounded. I'd use this as one factor, which has increased export volumes and also increased commodity prices. A weaker exchange rate has meant that causes some inflationary pressures, and strong non-mining investment. So your key ones, if you get asked like 2 reasons that might cause the RBA to implement a more contractionary stance, you could say, well, if inflation gets above the target range, if the dollar continues to depreciate, if overseas growth continues to grow, and if consumer confidence continues to grow, could all be reasons why they might tighten monetary policy later this year. Thank you.